What's up everybody and welcome back to another video. So this is gonna be my second ever Options Police video, which is a series where I go into the weirdest, most unusual options activity that I can find on stocks, and this one is yet again gonna be on Tesla stock, unsurprisingly, because this one has a lot of options activity on it. And before this video starts, I would love it if you guys just quickly left a like on this video. That'd be really awesome. That would help the YouTube algorithm a lot. Graham Stephan would be happy. And without further ado, let's get right into it. So, the option we're going to be checking out is the January 15th, 2021 400 call. That means that this option expires on the 15th of January, this upcoming year, and the strike price is 400. And this is honestly one of the craziest bets probably I've ever seen in terms of dollar amount and just the general risk of the option, because this option is barely in the money. I mean, if Tesla stock goes down like 5%, this option is going to lose like half of its value, which is crazy. And this option has 16,000 contracts of open interest. That's how many contracts people are holding. Each contract right now is worth about $5,000. So with the help of this hopefully trusty calculator from Google, we can see that there's $80 million in this option. That is a ton, people. $80 million. That's crazy, because generally big money, like hedge funds or whatever, which is probably most of the people who own this option because it's so much per contract, you know. Most regular people can't afford to put $5,000 on one option. So it's most likely hedge funds that own this thing. And usually hedge funds go with something a lot safer, like, I don't know, a 300 call or something, like something down here. Yeah, like something like this. This seems more like what a hedge fund would generally do. A 300 call. And we can see that this is the case. I mean, there's more money in the 300 call than the 400 call, obviously, because it's much less risky. And even if Tesla goes down like 10%, the contract is still going to keep most of its value. So hedge funds are basically betting that Tesla stays above 400 and that it goes to at least 450. Because that's the break-even price right now, right? Since the strike price is 400 and each share costs $50 in this option. That's a pretty risky bet, because basically they're betting that the stock goes up like 10% from here. And even if Tesla doesn't move at all, this contract loses over 70% of its value. That's really risky, considering that there's $80 million in this contract. So I don't know. Make what you will of this, but hedge funds are getting pretty risk-taking with this option. I mean, they're really going risky here with having $80 million on the line, with an option that, if it doesn't go up, loses more than half of its value. So, I don't know, hedge funds are really confident on this trade, and I'm not going to touch this because I don't have $5,000 to throw into an option, okay? I do have more than $5,000, but I would need to sell, like, my Tesla stock to buy this. And I'm not going to risk all my money that I have in Tesla stock, or most of it, to put it into an option that very well might lose 70% of its value in 2 months, which is just crazy in my opinion. So I don't know. Anyways, if you guys enjoy this video, leave a like and subscribe. Comment down below what you think about these hedge funds going super risk mode and just going kind of Wall Street bet style almost. Except it's in the money contracts, so it's not quite as risky, I guess, as Wall Street bets. Not as crazy, but I mean, it's similar. It's really similar to something that Wall Street bets would do, except it's not Wall Street bets because there's so much money in this contract that there's no way it could be Wall Street bets, because they don't have this type of money. They don't have 80 million bucks. So I don't know. Down below your opinion, I guess, and catch you guys next time. Peace.